Welcome to the deep dive. Real quick, this deep dive is brought to you by CertFuel.
Yeah, they've got a full securities industry essentials course.
Right, with like adaptive study quizzes, smart flashcards, and unlimited practice exams that are weighted just like the real thing. Check it out at certfuel.com. All right, let's get into it.
Let's do it.
So imagine you walk into a deli, right? You buy this massive, delicious turkey and Swiss sandwich.
Okay, I'm with you. Sounds great.
Right. You take one giant bite out of it, chew it up, and suddenly you decide, you know what? I don't really want this anymore.
Just completely change your mind.
Exactly. So you walk out of the deli, you take the subway down to Wall Street, you march right onto the trading floor of the New York Stock Exchange, hold up your half-eaten sandwich, and start screaming at the day traders trying to sell it to them.
I mean, you would be laughed completely out of the building.
Oh, escorted out by security immediately.
Ah.
It is literally impossible to sell a half-eaten sandwich on a public exchange.
Yeah, it's a very visceral, slightly gross image, honestly.
Thank you, I try.
But it perfectly captures the reality of what we are tackling today. Because we are exploring the wild, highly regulated, and honestly deeply misunderstood alternative universe.
Exactly. So to you, the listener, listening to this on your walk in your car or just staring at your ceiling, we have a very specific mission today.
A very critical mission if you're taking the exam.
Right. We are conquering alternative investments for the SIE exam. And we are not messing around here because this unit is just a monster.
It really is. It makes up a massive chunk of your exam.
Yeah, we're talking about it being a core part of the 33 questions that make up 44% of your total score.
You absolutely cannot pass the Securities Industry Essentials exam without having a rock-solid, almost instinctual understanding of these concepts.
Right.
It's not just about memorizing definitions either. You have to understand the mechanics of why these products exist in the first place.
Right, but here is the problem with that. Standard, dry financial textbooks are an absolute cure for insomnia.
Oh, totally. Just walls of text.
Yeah, and if your brain works like mine and you have that ADHD wiring where you need constant stimulation, reading a wall of text about like tax pass-through entities is just going to make your eyes glaze over.
It's brutal.
So we are officially breaking the fourth wall today. We are tossing the textbook out.
Love it.
To keep you locked in, we are going to use absurd analogies, completely ridiculous hypothetical scenarios, and I am going to be throwing spontaneous pop quizzes at you to force your brain to engage. We're going to lock this information in permanently.
Which is honestly the absolute best way to learn finance.
Right.
Because the rules of the SEC and the IRS aren't just arbitrary laws handed down from a mountaintop. They are direct reactions to human behavior.
Usually really bad human behavior.
Exactly. Usually bad behavior. If we can attach the rules to relatable, flawed characters, you will never forget them on exam day.
I love that. So to help us out, let me introduce our three recurring fictional exam test subjects. You're going to be spending a lot of time with this trio today, so, get to that.
Let me the cast.
First, we have Passive Pete. Pete is a guy who wants to do absolutely zero work.
Zero.
Yeah, if he could legally melt his body with his living room couch, he would. He has no interest in running a business, but he absolutely loves tax benefits.
Sounds like a lot of investors, honestly.
Right. Second, we have Bossy Brenda. Now, Brenda is pathologically incapable of letting things go.
Oh, boy.
She has to micromanage everything. She has to be the one in charge. She has to critique the paint color on a wall she doesn't even own. And spoiler alert, this trait is going to constantly get her into deep, deep financial trouble.
I can already see the legal fees piling up for Brenda.
Oh, she's going to need a good lawyer. And finally, High Roller Harry. Harry is a multimillionaire who walks around with this unearned sense of invincibility.
The guy who thinks the rules don't apply to him.
Exactly. He thinks he is totally immune to risk, and he is constantly trying to get past the velvet ropes into exclusive clubs.
A perfect cast to illustrate the absolute best and worst case scenarios in alternative investments, really.
So before we throw Pete, Brenda, and Harry into the fire, give me the 30,000-foot view.
Okay, the big picture.
Yeah, if there is one overarching philosophy the listener needs to keep in mind for every single product we talk about for the next hour, what is it?
Okay, so if you want to synthesize the core theme of this entire deep dive, it all comes down to a fundamental trade-off.
A trade-off, okay.
Right. Alternative investments offer incredibly unique benefits that you just cannot get in the regular stock market. We are talking about major tax perks, massive portfolio diversification, and potentially sky-high returns.
Sounds amazing. Why does everyone do it?
Because finance is a scale. The market does not give you those magical benefits for free.
Right. There's always a catch.
Exactly. To get them, you have to accept massive, painful trade-offs in two very specific areas.
Which are?
Number one is liquidity, meaning how fast can you get your cash out if you desperately need it?
And number two?
Number two is investor eligibility, meaning who is legally allowed to even step foot in the door in the first place.
Okay, so high benefits, but your money might be trapped in a burning building, and the bouncer might not even let you into the club at all.
Precisely. Every alternative investment we cover today, whether it's direct participation programs, REITs, or hedge funds, they all play with those two dials, liquidity and eligibility.
Okay, well, let's start turning those dials. We need to figure out what makes these investments alternative in the first place.
Right, we have to contrast them with the normal stuff.
Yeah, and to do that, we actually have to look at the traditional corporate world. We have to talk about how alternative investments magically avoid the single biggest, most agonizing drag on traditional investing.
Ah, you're talking about the dreaded double taxation.
I am indeed. The double tax. Let's break down the standard C corporation model first, just so we know what we are running away from here.
Okay, think about a massive traditional C corporation. Let's say it makes $1 million in profit selling shoes.
Okay, they made $1 million.
Right. The IRS immediately steps in and takes a giant slice right off the top. The corporation itself, as a legal entity, pays taxes on those profits at the corporate tax rate.
Right.
And that is tax event number one.
Okay, so the entity pays.
Yeah.
The company is slightly poorer now, but they still have a bunch of after-tax profit left over.
Right. Now, the corporation decides to reward its loyal shareholders by paying out those remaining profits as a cash dividend.
Sweet. I love dividends.
Everyone does. So you, the everyday investor, receive that dividend in your brokerage account. But at the end of the year, you get a 1099 DIV form in the mail.
Oh, no.
And guess what? You now have to pay your own personal income taxes on that exact same money. That is tax event number two.
It is the ultimate IRS double dip.
It really is.
Like the money gets taxed when the company makes it, and then the exact same dollar gets taxed again when it is handed to you. It's just brutal. It eats your returns alive.
It's a huge drag on compounding.
But here is where it gets really interesting. Enter our first alternative product. The Direct Participation Program, or DPP.
The DPP, yes.
The defining feature of a DPP, the absolute core concept you must remember for the exam, is that there is zero corporate-level taxation.
None with no taxes on its profits.
It's like the business entity is a ghost, right? The IRS just looks right through it.
Exactly like a ghost.
Instead, all the income, the gains, the losses, and the tax deductions do what we call flow-through or pass-through straight to the investor's personal tax return.
Right. Instead of a 1099 DIV form, the investor gets a magical piece of paper called a K-1 form every single year.
The infamous K-1.
The K-1 is the golden ticket of the DPP world. Because there is no entity-level tax, that money is only taxed once, and that's at your personal level.
Okay.
The economic consequences of the business, whether they are amazingly good or terrifyingly bad, participate directly with your personal tax situation, hence the name Direct Participation Program.
Okay, listener, put your thinking cap on right now. I'm going to throw a scenario at you, and I want you to figure out the answer before the expert does. Ready?
Let's see how they do.
Let's bring in our guy, Passive Pete. Now, Pete has a normal day job where he makes a $100,000 salary.
Solid income.
Right. But Pete also invested in an oil drilling DPP. And at the end of the year, Pete gets his K-1 form in the mail from the oil drill, and it shows a massive $20,000 business loss.
Ouch.
Yeah. So Pete thinks to himself, sweet, I have a $100,000 salary, but I lost 20 grand on this oil rig. I'll just subtract the loss from my salary and tell the IRS I only made $80,000 this year.
That's the dream, isn't it?
Right. So here's the question for the listener. Can Passive Pete actually do that? Can he use that K-1 loss to wipe out the taxes on his day job salary? Give it a beat. What do you think the IRS is going to say to that?
It sounds like an absolute dream scenario for Pete, a really brilliant loophole.
It sounds like exactly what a rich guy would do to avoid paying taxes. I want it to be true, but is it?
The answer is an absolute, definitive, aggressive and no.
Oh, bummer.
And this is a massive exam trap. The test writers love testing this exact scenario because it trips up so many people.
Wait, why is it a no? If the losses pass through to my personal tax return and my salary is on my personal tax return, why can't I mash them together? Like, that's just how math works.
Because the IRS isn't stupid.
Well, fair enough.
Back in the 1980s, wealthy people were doing exactly what Pete is trying to do. They were buying into terrible businesses that were actively designed to lose money on paper just so they could generate massive tax write-offs against their high salaries.
Not like tax shelters.
Exactly. So the government stepped in and created the passive activity rules. They decided to categorize all your money into different strictly quarantined buckets.
Buckets.
All right. The losses generated by a DPP are legally classified as passive losses.
Because Pete is passive. He's literally just sitting on the couch doing nothing for the business.
Precisely. And the strict, unbreakable rule is this. Passive losses can generally only be used to offset passive income. You cannot cross the streams.
Ghostbusters rule. Don't cross the streams.
Right. You cannot use passive losses from a DPP to offset your active wages, your salary, or your active portfolio income, like regular stock dividends.
Wow.
Now, if Pete has passive income from another DPP that actually made money,
like a real estate deal or something.
Sure, then he can use the oil drill loss to offset that other DPP's gain, but he absolutely cannot use it to shield his $100,000 day job salary. The buckets cannot mix.
So the pass-through structure is a feature. It's great. It leads to the benefit of no double tax. It generates the K-1 form, but it comes with the heavy restriction of the passive activity rules.
That is exactly right.
That is a causal chain you need to memorize, listener. K-1 loss equals passive loss equals only offsetting passive income.
And there is one more major restriction on those losses you need to know about. It's called the at-risk rule.
Time out. The at-risk rule. Break that down for me because that sounds tricky.
It's the ultimate IRS reality check. Let's say Pete invests $10,000 of his own cash into a real estate DPP.
Okay, 10 grand in.
But the business completely tanks, the accounting gets really weird, and his K-1 form arrives showing a theoretical loss of $50,000.
Wait, how does he lose 50 if you only put in 10?
Exactly. That's the funny accounting part. So can Pete claim a $50,000 loss on his taxes?
I'm going to guess no.
No. He can only deduct losses up to the amount he actually has at risk in the real world. In this case, he only risked his $10,000 investment.
So he can't claim a phantom loss for money he never actually put on the table.
Exactly. The at-risk amount is usually your initial cash investment plus any recourse debt.
Hold on. Define recourse debt for me in plain English. Does that mean like they can come take my actual car?
Yes, essentially. Recourse debt is a loan that you are personally, legally obligated to pay back out of your own pocket if business defaults.
Yikes.
Right. If the bank can have a repo man take your personal car or foreclose on your personal house to settle the business debt, that is recourse debt. Because your personal assets are on the line, the IRS considers that money truly at risk, and you can claim losses against it.
But what if it's the other kind, non-recourse?
If it's non-recourse debt, meaning the bank can only seize the business's assets and can't touch you personally, you are not at risk, and you get no tax deduction for it.
That makes total sense.
It stops wealthy investors from using DPPs as bottomless, magical tax shelters based on leverage they aren't even responsible for.
Okay, so we've established that the tax benefits are cool, but they're heavily restricted by buckets and at-risk rules. Now, let's talk about the downside. The massive trade-off we mentioned at the start.
Liquidity.
We talked about liquidity being a dial. With the DPP, that dial is turned all the way down to zero.
Below zero, almost.
This brings us back to the half-eaten sandwich on the floor of the stock exchange. That is exactly how hard it is to sell a direct participation program.
There is absolutely no active secondary market for DPP interests, period.
The exam loves to test this. They will try to trick you. They'll ask, can an investor easily liquidate their DPP shares on the NASDAQ?
The answer is always no. They are unlisted securities. When you buy into a DPP, you are not dating that investment. You are marrying it.
Till death do us part.
Pretty much. You should be fully prepared to hold it for the entire life of the program, which is frequently 7, 10, or even 12 plus years.
12 years. Imagine handing over 50 grand and not being able to touch a single dime of it for over a decade.
It's a huge commitment.
And because of that brutal illiquidity, the regulators step in. Specifically, FINRA Rule 2310. What does this rule mandate?
Well, because you cannot just log into an app and hit a sell button if you suddenly need cash for, say, a medical emergency. FINRA Rule 2310 places incredibly strict suitability requirements on these products. Registered reps cannot just sell a DPT to anyone who walks through the door. First, the investor must have the net worth and income to actually bear the economic risk.
Meaning, if they lose the whole investment, Or if their money is trapped in a vault for 12 years, it won't ruin their life.
Right. You cannot put grandma's grocery and prescription money into an unlisted oil drilling DPP.
That would be horrible.
It would be a huge violation. The broker must have reasonable grounds to believe it's a suitable recommendation, and they must conduct extensive due diligence on the program itself before ever bringing it to a client.
And what about the fees?
Good point. FINRA Rule 2310 explicitly states that any compensation paid to the underwriters or broker-dealers who sell these things must be fair and reasonable. Because these are complex, opaque, illiquid products, regulators really want to make sure the fees aren't predatory.
All right, listener, let's recap the big three things for DPPs. Number one, pass-through taxation. That means no double tax, you get a K1.
Right.
Number two, they're incredibly illiquid. There's no secondary market. It's a half-eaten sandwich.
Yeah.
Number three, massive suitability requirements under FINRA 2310. If an exam question describes an investment with those three traits, it is screaming the letters DPP at you.
Absolutely.
So if a DPP is just a broad tax concept, what does it actually look like in the real world? Like, how are they built? Who is actually running the show?
That's a great question.
To answer that, we have to look at the most common legal structure for a DPP, the limited partnership.
The classic LP.
This is all about the ultimate power dynamic.
The limited partnership, or LP, is a brilliant legal structure because it bifurcates, or basically splits, the responsibilities and the risks between two very different types of partners.
Let's bring our characters back to explain this dynamic. In the red corner, we have Gary, the general partner, or the GP. And in the blue corner, we have our old friend, Passive Pete, acting as the limited partner, or the LP.
Let's look at Gary, the general partner, first.
Okay, Gary.
Gary is the one running the business. He is the active participant. He is out there signing the vendor contracts. He is hiring the workers. He is deciding exactly where to drill for oil.
He's the boss.
Right. And because Gary holds all the power and makes all the decisions, he has a strict fiduciary duty to act in the best financial interests of the limited partners. He can't just steal the money or self-deal.
Gary is the captain of the ship. But because Gary is steering the ship, what happens if Gary steers that ship straight into an iceberg?
That brings us to the core concept of liability. In business law, the fundamental rule is that liability is directly tied to control.
Liability equals control. Got it.
Because Gary makes all the decisions, Gary bears unlimited personal liability.
Unlimited.
Unlimited. If the partnership gets sued for negligence or goes bankrupt owing millions of dollars, Gary's personal assets, his house, his car, his children's college fund, are all on the line to pay those debts.
Ouch. Unlimited personal liability. That is terrifying.
It is a massive risk.
But what about Passive Pete? He's a limited partner. What does he do all day?
Pete's role is to write a check, hand it to Gary, and then go sit on his couch.
His favorite activity.
Exactly. He provides the capital. He is a purely passive investor. He has absolutely no say in the day-to-day management of the business. He can't hire people. He can't fire people. He can't sign contracts with suppliers.
And because he has no control, what happens?
Because he has no control, his liability is strictly limited to the amount he invested, plus any of that recourse debt he agreed to.
Okay.
If the business goes completely under, Pete loses his initial investment, but the angry creditors cannot come after his personal house or his personal bank account.
So limited control equals limited liability. They are intrinsically legally linked.
Exactly.
But listener, pay attention. Put your phone down if you are looking at it. This brings us to one of the biggest, most heavily tested exam traps in the entire unit, the management boundary.
Oh, this is a huge one.
I'm going to bring in Bossy Brenda for this one.
Perfect candidate.
So Brenda invests $50,000 into a real estate limited partnership. She signs the paperwork as a limited partner. Her legal job is to sit back, do nothing, and wait for her K-1 form.
Just like Pete.
Right. But remember, Brenda is incapable of letting things go. She's a micromanager. So Brenda decides to drive her car down to the construction site just to, check in.
Oh, no.
She sees the contractors painting the lobby wall a shade of eggshell white, and she thinks it should be cream.
Typical Brenda.
She completely loses her mind.
Yep.
She storms in, starts yelling at the contractors, fires the foreman on the spot, and grabs a clipboard to start signing new purchase orders for better paint.
She's totally taking over.
Think about this for a second, listener. Give it a beat. What just happened to Bossy Brenda's legal status?
She crossed the boundary.
She didn't just cross it, she leaped over it. She bulldozed right through it. Expert, explain exactly what the exam is going to ask about this causal chain.
The exam wants you to know the exact brutal legal consequence of her actions. Here is the causal chain. Management participation leads to the immediate loss of limited partner status,
Which means,
which leads directly to unlimited personal liability.
let me role play this for a second so it really sticks in your brain.
Yeah.
Let's say our phone rings. Ring, ring.
Hello.
Brenda, it's your lawyer. I just got a frantic call from the job site. What are you doing? Put down the clipboard right now.
I'm just picking a paint color.
You are a limited partner. If you fire one more contractor, you are acting as a general partner. The courts are going to pierce your limited liability shield. If a crane falls over tomorrow and crushes a building, they aren't just going to sue the business. They are going to take your house, Brenda. Get in your car, drive home, and do not speak to anyone. Click.
I mean, it's a funny visual, but it is 100% legally accurate.
It's serious business.
The very second a limited partner participates in day-to-day management decisions, they forfeit their legal protection. By acting like a GP, they inherit the risks of a GP. The exam will give you a scenario exactly like Brenda's, and the correct answer is always that the investor loses their limited liability.
LPs invest money, GPs make decisions. Never, ever mix the two. Oh, and one more quick thing about Gary the GP.
Yeah.
Because he has unlimited liability and he's taking on all this risk, can the LPs just, vote to fire him whenever they get annoyed with him?
No, it's really not that simple. Removing a general partner typically requires the consent of a majority of the limited partners, and it is considered a major structural change to the partnership. You can't just fire him on a whim.
Okay, so LPs trap your money and force you to rely entirely on Gary the GP.
Yeah,
But what if passive Pete doesn't trust Gary?
a valid concern.
What if Pete wants to co-own a massive physical piece of real estate, like a giant shopping mall, but he doesn't want to be locked into a complex partnership entity with a guy who might bankrupt him? How does he bypass the partnership entity entirely?
This brings us to another highly testable DPP structure, tenants in common or TIC.
The divisible castle. I love this concept. Explain the TIC structure to us and commit to the castle metaphor.
Will do. Think of a TIC as a direct co-ownership arrangement. It is fundamentally different from a limited partnership because a TIC is not a separate legal entity.
Wait, say that again. It's not an entity. Like there's no LLC or LP.
Correct. In a limited partnership, the partnership itself owns the assets. In a TIC, there is no middleman entity. Each individual investor holds an undivided fractional interest in the physical property itself, and each person actually holds a separate legal deed for their specific share.
Let's visualize this with the divisible castle. Pete and 3 of his buddies buy a massive medieval castle as tenants in common.
Okay, castle.
Undivided fractional interest means Pete owns 25% of the total value of the castle. But he doesn't just own the North Tower, right?
Right.
He owns 25% of the moat, 25% of the drawbridge, 25% of the throne room. It is undivided. Every single stone is co-owned.
Exactly.
And the ownership shares don't even have to be equal. Pete could own 10%, someone else could own 50%, another guy owns 40%.
Exactly. And because there is no separate business entity sitting in the middle, the tax treatment is still a pure pass-through. Each owner just reports their direct share of the castle's rental income and maintenance expenses directly on their personal tax returns.
Now here is the absolute superpower of the TEOC: independence.
This is crucial for the exam. Because Pete holds a separate deed for his fractional interest, he acts as an independent owner regarding his slice of the pie.
So what can he do with it?
He can sell his share of the castle, he can transfer it, he can take out a loan against it, or he can bequeath it to his children in his will without needing a single drop of permission from the other co-owners.
If he wants out, he just sells his deed. He doesn't have to call a board meeting or ask Gary the GP for permission.
Right, he's totally independent.
But listener, here comes the exam trap. Do not, under any circumstances, confuse tenants in common with joint tenancy.
Oh, that is a vital distinction. In joint tenancy, which is typically used by married couples, there is a legal concept called the right of survivorship.
And what does that mean?
That means if one owner dies, their share automatically and instantly goes to the surviving owner.
Right. But in a TIC, there is any drow right of survivorship.
None.
If Pete dies, his 25% share of the castle does not go to his buddies. It goes to whoever is named in his will. His kids inherit his 25% of the moat and the drawbridge.
Correct. Remember that for the test. No right of survivorship in a TIC. Your heirs get your share.
Now, why do incredibly wealthy real estate investors absolutely love the TIC structure?
Yeah.
Why deal with co-owning a castle with 10 other people? It all comes down to a massive tax loophole, the 1031 exchange.
Yes, Section 131 of the IRS tax code. It is one of the most powerful wealth-building tools in real estate.
Explain how it works.
A 1031 exchange allows an investor to completely defer paying capital gains taxes when they sell an investment property, as long as they take all of those profits and immediately swap them into a new, like-kind replacement property.
Let's walk through this. High roller Harry sells a modest apartment building for a massive $5 million profit. Normally, the IRS would knock on his door and hit him with a brutal capital gains tax bill. Millions of dollars just gone.
Just wiped out by taxes.
But Harry uses a 1031 exchange. He says, hold on, IRS, I'm not cashing out. I'm taking this $5 million and buying a new, bigger property. And the IRS says, cool, since you are keeping the money in the real estate market, you owe zero taxes today.
Exactly.
But here is where the tick comes in. What if Harry doesn't want to deal with the headache of buying an entire new $5 million building all by himself?
That is the beauty of the structure. Harry can use his 1031 exchange money to buy a tech interest in a much larger institutional grade property.
Like what?
Instead of buying a whole new $5 million apartment building, he can buy a $5 million fractional tech interest in a $100 million skyscraper in Manhattan alongside other wealthy investors.
He gets to completely defer his taxes and upgrade to a world-class property that he could never afford on his own. It's brilliant.
It really is.
But there is a limit, right? The SEC doesn't let just anyone do this with 1,000 people.
Right. To prevent these tiered arrangements from basically becoming giant, unregulated mutual funds, the IRS limits tier arrangements used in 1031 exchanges to a maximum of 35 co-owners.
35 co-owners maximum. Listener, write that number down. If you see 35 co-owners on the exam, think TIC and 1031 exchange.
Good tip.
Okay, we've covered LPs and TICs.
Yeah.
But let's be real. They are highly illiquid. The paperwork is a total nightmare. You have to deal with K-1 forms, and you usually have to be rich to even get an invite to the table.
Yeah, they aren't exactly mom and pop investments.
Right. So what if the everyday investor, just regular person with a standard brokerage account and $1,000, wants exposure to real estate without the headache of holding a deed or worrying about unlimited liability?
That exact problem is why Congress stepped in back in 1960. They wanted average Americans to be able to invest in large-scale real estate, so they created the Real Estate Investment Trust, or REIT.
The REIT, R-E-I-T. This is a massive part of the exam.
Yeah.
How is it structured differently than what we just talked about?
Well, unlike the DPPs we just discussed, which are structured as partnerships or direct co-ownerships, a REIT is structured as a trust or a corporation.
Okay, a trust or a corp.
Its entire legal purpose is to own, operate, or finance income-producing real estate. It was designed to give everyday people access to massive portfolios of real estate, just like a mutual fund gives people access to a diversified portfolio of stocks.
But wait, time out. If a REIT is structured as a corporation, didn't we say at the very beginning of this deep dive that corporations suffer from the dreaded double taxation?
We did say that.
How does a REIT avoid getting crushed by the corporate tax? Are they just using some giant loophole?
It's not a loophole. It is a very strict, legally mandated rule. And it is the single most important fact you need to know about REITs.
Drum roll, please.
To avoid corporate-level taxation, a REIT must distribute at least 90% of its taxable income to its shareholders every single year in the form of dividends.
90%. They basically have to empty their pockets and hand all their cash to the shareholders every year.
Exactly. If they distribute 90% or more, the IRS says, okay, since you are acting as a conduit and passing the money to the people, the REIT entity does not have to pay corporate tax on that distributed income. It is a massive tax shield.
But what if they miss it? What if they distribute like 89.9%?
If they miss that 90% threshold, even by a fraction of a percent, they face a harsh, immediate 4% excise tax penalty on the shortfall, and they risk losing their REIT status entirely.
Wow. Okay, so the REIT passes the income down, avoiding the double tax. But here is where we hit a massive exam trap alert. Listener, I am asking you this directly. Think hard about the logic we just discussed.
This is a tricky one.
Since the investor is receiving this income as a dividend in their brokerage account, do they get to apply that sweet, low qualified dividend tax rate to their REIT income when they file their taxes? Think about it. Does a REIT dividend get the lower qualified rate?
I mean, it is so incredibly tempting to say yes. It's called a dividend after all.
But the answer is no, it does not.
And we need to explain exactly why, because understanding the why is what will save you when the exam tries to confuse you. Let's look at the mechanics. Why is a qualified dividend qualified in the first place?
Let's compare it to like an Apple stock dividend. When Apple pays a dividend to its shareholders, Apple has already paid a massive corporate tax bill to the IRS on those profits.
Right.
Because that pool of money has already been taxed once at the corporate level, the IRS gives the individual shareholder a break. They'll let you pay a lower qualified tax rate on that dividend. It's a reward, an acknowledgement that the corporate tax was already paid.
Now apply that exact same logic to the REIT. Did the REIT pay corporate taxes on the money it's handing you?
No. Because of the 90% rule, they avoided the corporate tax entirely.
Precisely. The income has never been taxed by anyone. It is completely raw, untaxed money hitting your account.
So the IRS wants their cut.
Right. Therefore, the IRS says, we aren't giving you a discount. We haven't gotten our cut yet. The shareholder must pay their full standard ordinary income tax rate on REIT dividends.
Pass-through of rental income means ordinary income tax rates for the investor. That is a guaranteed exam question right there. REIT dividend equals ordinary income.
Definitely.
Now, there is a weird, tricky nuance here. Sometimes a REIT won't just send you income. Sometimes they will send you a distribution labeled return of capital.
Yeah.
This sounds awesome to Passive Pete. He sees return of capital and thinks, sweet, here's some of my money back, tax-free. Is it free money?
It is absolutely not free money, and it is a major tax trap that catches a lot of investors off guard. A return of capital distribution is not taxed at the exact moment you receive it. It is tax deferred.
Okay, deferred.
So you might look at your broker's statement and mistakenly think you got a tax-free bonus.
But the IRS always gets their due. Eventually.
Always. When you receive a return of capital, it mathematically reduces your cost basis in the investment.
Stop there. Explain cost basis like I am 5 years old.
Cost basis is simply the original amount of money you paid to buy the investment. It's your starting line. If you bought one share of a REIT for $100, your cost basis is $100.
Simple enough.
Let's say a year later, you receive a $10 return of capital distribution. You don't pay taxes on that $10 today, but your cost basis just dropped from $100 down to $90. Your starting line moved backwards.
So what? Why should I care where my starting line is if I have the $10 in my pocket right now?
You will care very deeply when you eventually sell that share, because capital gains taxes are calculated on the difference between your final sale price and your cost basis.
Oh, I see where this is going.
If you sell that share 5 years later for $150, you aren't paying taxes on $50 of profit. You know, the $150 sale price minus your original $100.
Right.
You are paying taxes on $60 of profit.
Right.
The $150 sale price minus your new lowered basis of $90.
Boom. A massive capital gains tax bill waiting in the shadows to jump out at you. The tax is deferred, not eliminated. Do not let the exam trick you into thinking a return of capital is a permanent tax-free gift.
It never is.
All right, let's talk about flavors. Not all REITs do the same thing. And more importantly, not all of them are easy to sell. Let's break down the three main types of REITs based on what they actually buy with the investor's money.
Okay, the first, and by far the most common, is the equity REIT. These are the traditional landlords of the corporate world.
Like actual real estate.
Yes. They take the pool of money and actually buy physical income-producing properties. Office buildings, massive apartment complexes, shopping malls, data centers, even hospitals.
And what is their main source of income?
Collecting rent checks from tenants. Plus, they benefit from the physical property values appreciating over time.
Now, why do financial advisors love putting their clients into equity REITs during times when the cost of groceries and gas is skyrocketing?
Because equity REITs offer strong inflation protection.
Make that make sense.
Think about the mechanics of inflation. When inflation hits, the overall cost of living goes up. What do landlords immediately do?
They raise the rent.
They raise the rent. Furthermore, as the cost of building materials and labor goes up, the replacement cost of buildings goes up, which means the value of existing physical properties goes up as well. So the REIT's income stream and its underlying asset values naturally rise alongside inflation.
Equity REITs equal inflation hedge. Got it. Now let's look at the complete opposite. The mortgage REIT, or MREIT.
Mortgage REITs are fundamentally different beasts. They own absolutely zero physical property. They are not landlords, they are lenders.
Wait, a real estate investment trust that doesn't own any real estate? That sounds like a contradiction.
It does, but their involvement in real estate is purely financial. Instead of buying a skyscraper, they lend money to the developers who build the skyscraper, or they buy massive portfolios of mortgage-backed securities on the secondary market.
So where does their money come from?
Their income doesn't come from rent. It comes entirely from interest payments. They earn what is called the spread, the difference between the cheap, short-term interest rates they borrow money at and the higher, long-term interest rates they lend money out at.
Okay, here comes an exam trap, listener. If equity REITs are great for inflation, how do mortgage REITs handle a rising interest rate environment?
They get absolutely crushed, decimated. Mortgage REITs are highly, highly sensitive to interest rate risk.
I want to make sure I really understand this. Walk me through the bond math slowly. Why does the Federal Reserve raising interest rates destroy a mortgage REIT?
It hits them aggressively from two different sides. First, remember how we just said they earn the spread? They borrow short-term money from banks to fund long-term 30-year mortgages.
Okay, yeah.
If the Federal Reserve suddenly raises interest rates, the REIT's short-term borrowing costs spike immediately. Their debt becomes expensive overnight. But the income they are receiving from the 30-year fixed mortgages they already issued stays exactly the same. Their profit margin simply evaporates.
That makes perfect sense. Their costs go up, their revenue stays flat. But what happens to the underlying value of the mortgages they hold on their balance sheet?
This is where the bond math applies. Mortgages are just debt instruments, like bonds. The fundamental rule of bonds is that when interest rates go up, the value of existing fixed-rate debt goes down.
Because new bonds pay more.
Right. Why would someone pay full price for your old 3% mortgage when they can buy a brand new one yielding 6%? So not only is their profit margin squeezed, but their entire portfolio of mortgages actually loses market value.
It's a brutal double whammy. Rising rates squeeze profits and devalue assets simultaneously. So if the exam asks which REIT provides inflation protection, it's equity, not mortgage. If it asks which one is most sensitive to interest rates, it is mortgage.
Exactly. And just for completeness, the third type is simply a hybrid REIT, which combines both strategies. They own some physical properties and they hold some mortgages. It provides a middle ground risk profile.
All right, now we need to talk about the liquidity illusion. We know the types of REITs, but the exam loves to test how they are actually sold to the public. This is the listing status trap.
Listing status dictates how easily you can get your money out, and it is broken down into three specific categories: listed, public non-traded, and private.
Let's start with the easy, safe one, listed REITs.
These are fully registered with the SEC, and they trade openly on major stock exchanges like the NYSE or NASDAQ. You can log into your brokerage app right now and buy or sell shares instantly during market hours.
Just like regular stock.
Just like a stock. The price is determined continuously by the free market supply and demand.
High liquidity, daily pricing, full transparency. Beautiful. But now, wake up, listener. Pay very close attention to this next category. Public non-traded REITs.
This is where retail investors get seriously hurt, and this is exactly what FINRA issues aggressive investor alerts about constantly.
Let's break down the name. Public. That word makes it sound safe, regulated, and easy to sell. Right.
It is a highly deceptive naming convention. They are called public solely because they are fully registered with the SEC. They file the exact same 10K and 10Q financial reports as a listed company.
No.
But the second half of the name is the killer. Non-traded.
Meaning they do not trade on an exchange.
Correct. You cannot log into your app and sell them. There is no active secondary market. Despite being SEC registered and quote-unquote public, they are highly painfully illiquid.
Let's talk about the brutal reality of these products.
Yeah.
Starting with the fees. If Passive Pete decides he wants to invest $10,000 into a public non-traded REIT
Right.
because a broker pitched him a super high dividend yield, what actually happens to his money on day one?
He is going to lose a massive chunk of it immediately. Non-traded REITs are notorious for charging extortionate upfront fees. The commissions paid to the broker who sold it to him, plus the internal offering costs, can easily exceed 10 to 15% of the initial investment.
Let's do that math out loud so it sinks in. Pete invests $10,000. 15% goes straight to fees. That means $1,500 is gone before the ink on the contract is even dry.
Vanished.
Only $8,500 actually goes to work buying real estate. You are starting the race 10 miles behind the starting line.
And it gets worse regarding transparency because they don't trade on an exchange. There is no daily market price. You don't know what your shares are actually worth on any given Tuesday. Instead, they use something called a net asset value, or NAV.
Define NAV for me.
It's an estimate of what the underlying real estate is worth divided by the number of shares. But the problem is with non-traded REITs that NAV is often incredibly stale.
Stale, like old bread.
Yeah, it might only be updated periodically, like once a year. So the price you see on your monthly statement might not reflect the actual current value of the real estate if the market has crashed recently.
And what if Pete gets sick of it and wants to sell his shares?
Good luck to him. They often have mandatory holding periods of 8 years or more. They might boast about offering redemption programs where the REIT promises to buy back your shares if you really need the money, but you have to read the fine print.
There's always fine print.
Always. The REIT's board of directors can suspend those redemption programs at any time for any reason. If the real estate market crashes and everyone wants out at once, the REIT will simply lock the doors and say, sorry, we aren't buying back shares right now.
And sometimes those massive dividend yields the broker promised, they aren't even coming from rental income. The REIT might just be borrowing money from a bank to pay the dividend, or worse, returning your own principal back to you to make it look like a high yield.
The exam causal chain here is vital to remember. No exchange listing means no daily price discovery, which means stale NAVs and limited redemptions, which results in severe illiquidity for investors. Do not ever confuse public with liquid.
Perfect. And just to round it out, the third category is private REITs. These aren't SEC registered at all. They're sold strictly through private placements. They have almost zero disclosure requirements, and they are the absolute most illiquid of the bunch.
Basically completely off the grid.
Okay, we have covered DPPs and REITs. Now, we're leaving the realm of standard investments and entering the absolute wild west of the alternative universe, a place where everyday retail investors are legally forbidden to enter. We are entering High Roller Harry's playground, a hedge fund.
Oh, hedge funds are absolutely fascinating because they represent the extreme opposite end of the regulatory spectrum.
How so?
Well, unlike mutual funds, which are heavily regulated by the Investment Company Act of 1940 to protect everyday mom-and-pop investors, hedge funds are explicitly designed to be exempt from those rules.
What is a hedge fund at its core?
At its core, it is simply a private investment pool. It's usually structured legally as a limited partnership or an LLC, very similar to the DPPs we discussed earlier. But the key difference is that the fund itself is completely exempt from SEC registration.
No registration at all.
None for the fund. There is no daily NAV requirement. There is no prospectus you have to hand to investors, and there are almost zero strict rules on what the manager can or cannot buy.
It's a black box. You hand them millions of dollars, and they do whatever they want behind closed doors. But wait, why does the SEC allow this unregulated black box to exist? Doesn't the SEC exist to regulate things?
The SEC allows it to exist entirely because of who they let in the door. The SEC's operating logic is that extremely wealthy, financially sophisticated investors don't need the government to hold their hand and protect them.
Oh, I see.
The assumption is that if you have $10 million, you can afford to lose the money, and you have the resources to hire lawyers and accountants to do your own due diligence.
So the SEC sets up velvet ropes. They put bouncers at the door. You have to prove you are rich enough to belong. Let's talk about the two main regulatory exemptions hedge funds use to avoid the 1940 Act registration.
The first is Section 3C1. This exemption says the fund is exempt from regulation as long as it has no more than 100 investors, and it does not make any public offering.
So you can't put a billboard on the highway or run a Facebook ad for a 3C1 fund.
Definitely not. Max 100 people. It's a very exclusive, invite-only country club.
But what if a star manager wants more than 100 people? What if they want to raise billions of dollars from thousands of rich people?
Then they have to use the other exemption, Section 3C7. This exemption allows for an unlimited number of investors.
Unlimited. Just anyone.
Unlimited. But there is a massive catch. To use this exemption, every single investor in a 3C7 fund must meet the definition of a qualified purchaser.
Okay, let's define the VIP list. Let's bring in High Roller Harry. Harry wants into a hedge fund. The bouncer at the door asks him for his financial credentials. Let's contrast the two levels of wealth the exam frequently tests. Accredited investor versus qualified purchaser.
Most people have heard the term accredited investor. It's really common in private placements. To be accredited, an individual must have a net worth exceeding $1 million, explicitly excluding the value of their primary residence.
So if your house is worth $1 million, but you only have 50 grand in your checking account, you are not accredited.
Correct. Your house doesn't count. Alternatively, you can meet the income test, making over $200,000 a year as an individual or $300,000 combined with a spouse for the past 2 years with the expectation of making it again this year.
So $1 million net worth or $200K income, that gets you accredited status. But what about the 3C7 fund, the one with unlimited investors? They require you to be a qualified purchaser. That is the ultra VIP room behind the regular VIP room. What is the threshold there?
It is a massive, massive step up. A qualified purchaser must have at least $5 million in investable assets.
Not just net worth.
Not just net worth and not illiquid businesses. $5 million in actual investments like stocks, bonds, or cash. It is significantly more exclusive than being just accredited.
So Harry shows his broker's statement. He's got $10 million on liquid stock. He is a qualified purchaser. The bouncer unclips the velvet rope and lets him in. Now Harry sits down at the mahogany desk with the hedge fund manager, and he gets introduced to one of the most famous or infamous fee structures in all of global finance. The 2 and 20?
Ah, yes. 2 and 20. This is the exact mathematical formula of how hedge fund managers become billionaires.
Listener, I am going to ask you a direct math question right now. I want you to work this out in your head. High roller Harry gives a hedge fund manager $1 million to manage.
A cool million.
Over the course of the year, the hedge fund manager does a great job and generates a 10% profit. So the fund gains $100,000.
Right.
Under a standard 2 and 20 fee structure, how much money does Harry actually have to pay the manager in fees? Think about it. 2% of something, 20% of something else.
Let's break down the math painfully slowly. It comes in 2 distinct parts.
Part 1, the management fee.
The 2 stands for a 2% annual management fee charged on the total assets under management. It is a flat fee charged regardless of whether the fund makes money or loses money. It's just for keeping the lights on.
Right.
So at the end of the year, Harry's account is worth his original $1 million plus the $100,000 gain. So $1.1 million total assets.
Okay, 2% of $1.1 million is $22,000. That's part 1.
Correct. Now part 2, the performance fee. The manager takes a 20% cut of the profits they generated. Harry's profit was $100,000. 20% of that is another $20,000.
So we add them up. A $22,000 management fee, LUS, the $20,000 performance fee.
Right.
Harry pays a grand total of $42,000 in fees. Wait, stop. He made $100,000 in profit, and the manager took $42,000 of it.
Yep.
That is over 40% of his gross gains going straight into the manager's pocket.
Exactly. It is an incredibly expensive structure that heavily drags down net returns. The industry logic is that the performance fee aligns the manager's interests with the investors. They only get that 20% cut if they actually make you money.
But hold on, let's talk about the moral hazard here. If the manager makes $100,000, he gets a $20,000 bonus. But what if he loses $100,000? Does he have to pay Harry $20,000 out of his own pocket?
No, of course not.
So it's heads I win 20%, tails you lose everything. Doesn't that heavily incentivize the manager to take insane, reckless gambles with Harry's money? If it works, the manager gets rich. If it blows up, Harry takes the loss.
It is a massive criticism of the hedge fund industry, yes. It encourages excessive risk-taking. However, there is one mechanism designed to protect the investor from paying fees for poor performance, and it's called the high watermark.
How does the high watermark work?
Let's say in year 2, the manager makes terrible bets. The fund loses money and Harry's account drops down to $900,000.
Okay, he's down.
In year 3, the manager does better and makes a gain, bringing the account back up to $1 million.
Can the manager charge his 20% performance fee on that $100,000 gain from $900,000 back to $1 million?
No. The high watermark rule says the manager only earns a performance fee on new net gains above the previous highest value the account ever reached.
Oh, I get it.
Since the high watermark for Harry's account was $1.1 million, the manager doesn't get a dime of performance fee until the account goes above $1.1 million again. It strictly prevents managers from double charging performance fees on simply recovering past losses.
Okay, that is somewhat comforting.
Mm-hmm.
Now, here is a quick exam trap alert before we move on to how they actually invest. We said the hedge fund entity itself is exempt from SEC registration. But what about the human being, the actual investment advisor who is running the fund?
Great distinction. While the fund entity is exempt under the Investment Company Act, the fund manager themselves, the firm managing the money, may still be required to register with the SEC as an investment advisor under a completely different law, the Investment Advisors Act of 1940.
So the fund is exempt, but the manager isn't.
Exactly. The fund's exemption does not automatically extend to the manager's registration status.
Tricky exam writers. Listener, make sure you read the question carefully to see if they are asking about the fund or the manager. All right, we know hedge funds are exclusively for the ultra-rich, and they charge insane fees. But why? What are they actually doing with the money that a regular mutual fund isn't allowed to do?
They employ incredibly aggressive, complex strategies. A standard mutual fund is heavily restricted. They mostly buy stocks and bonds and hold them, hoping the market goes up.
Right.
A hedge fund manager's goal is to generate absolute returns in any market environment, up, down, or sideways. And to do that, they use a massive arsenal of high-risk tactics.
The danger zone. Let's walk through the arsenal. The first one is short selling. Mutual funds rarely do this. Hedge funds do it all the time.
Short selling is a bet that a stock's price will fall. You borrow shares of a company from a broker, you sell them immediately at the high current price, and you hold the cash. You are hoping the price crashes.
And if it does?
If it does, you buy the shares back at the new, lower price, return the borrowed shares to the broker, and keep the difference as your profit.
That sounds smart. Why is it dangerous?
Because of the terrifying math of potential loss. If you buy a stock, normally say you buy a share of Ford for $100, the absolute worst thing that can happen is Ford goes bankrupt and the stock goes to zero. You lose your $100, your risk is strictly kept.
Yeah.
But let's say High Roller Harry's hedge fund decides to short sell a company that makes, experimental teleportation boots. The stock is at $10. The manager shorts it, thinking it's a total scam. But what happens if the very next day the company announces the teleportation boots actually work perfectly?
The stock price rockets to 200 or 5,000 or 10,000.
Exactly. And remember, the hedge fund borrowed those shares. They still have to buy them back on the open market to return them to the broker.
So if it goes to 10,000, they have to pay $10,000 to buy back a share they originally sold for $10.
Yes. And there is theoretically no limit to how high a stock price can go. Therefore, the potential loss on a short sale is mathematically unlimited. A bad short squeeze can and has bankrupted multi-billion-dollar hedge funds overnight.
Infinite loss. Love that for Harry. What is the next weapon in the arsenal?
Leverage. This simply means borrowing money from banks to amplify your investment returns. A mutual fund has strict regulatory limits on how much they can borrow. Hedge funds have almost no limits.
So Harry's fund has $100 million in equity. They go to a massive Wall Street bank and borrow another $100 million. Now they're investing $200 million. 2x leverage.
Right. And it amplifies everything. If that $200 million portfolio goes up 10%, they make $20 million. On their original $100 million equity, that is a 20% return. Leverage magically turns a 10% market gain into a 20% fund gain.
But leverage is a double-edged sword that cuts both ways.
It cuts twice as deep on the way down. If the portfolio drops 10%, the fund loses $20 million. That is a 20% loss of their actual capital.
Ouch.
And if the market really crashes, the banks that lent them the money will panic and issue a margin call. They will demand their loaned money back instantly, forcing the hedge fund to sell their assets at rock-bottom panic prices, locking in devastating, unrecoverable losses.
Okay, what about diversification? Mutual funds have strict rules about not putting all their eggs in one basket.
Hedge funds ignore that concept entirely. They use highly concentrated positions. If a manager has extreme conviction in one single company or one specific sector, they can dump 50% or more of the entire fund's capital into it.
Talk about putting it all in black.
Yeah, and they also use global macro strategies, which means making massive concentrated bets on entire economies, betting that a specific country's currency will collapse or that global interest rates will swing wildly in one direction.
It's swinging for the fences every single time. And the last big risk strategy is what they actually buy. We mentioned illiquidity before, but hedge funds take it to another level with private equity and distressed debt.
A retail mutual fund needs to calculate its net asset value at the end of every single day. So it mostly holds stocks that trade publicly on an exchange where the price is obvious and transparent. A hedge fund doesn't have to calculate a daily NAV.
So what do they buy?
They buy things that are incredibly hard to price. They buy massive private stakes in early-stage tech startups that aren't public yet. They buy the distressed, defaulted debt of bankrupt companies, hoping to restructure them.
And what specific risk does that introduce for the investor?
It introduces severe valuation risk. Because these private assets don't trade on an exchange, there is no real market price. The hedge fund manager often gets to use their own internal mathematical models to estimate what the asset is worth.
Wait a minute. The manager, who gets paid a 20% performance fee based on how much the assets go up, gets to be the one who decides how much the assets went up.
You see the massive conflict of interest there.
It is literally grading your own homework.
It really is. It can lead to extremely stale or wildly optimistic, inaccurate valuations. The numbers on Harry's monthly statement might look amazing, but if the fund actually tried to sell that private startup or that bankrupt debt in the real world, they might get pennies on the dollar.
Which perfectly transitions us into liquidity risk. Imagine you are in a building and it catches on fire. Everyone naturally runs for the exit, but when they get to the doors, they realize the doors are chained shut from the outside.
That's a scary thought.
That is exactly what it feels like to be an investor in a hedge fund during a market crash. You cannot just log into your app and hit withdraw.
Not at all. Hedge funds enforce strict lockup periods. When you hand them your millions, you legally sign an agreement that you cannot touch your money for a specified period, typically 1 to 2 years, sometimes much longer, for funds buying illiquid private assets.
So even if you see the manager making terrible, obvious mistakes on the news, you are trapped.
Completely trapped. And even after the lockup expires, you still can't just withdraw your money anytime you want. You are restricted to limited redemption windows, maybe only allowed to withdraw once a quarter or once a year. And you usually have to give 30 to 90 days advance written notice that you intend to withdraw.
And what if the market is crashing and everyone in the fund tries to leave at the exact same time?
The manager drops a gate. A gate is a legal provision that limits the total amount of money that can leave the fund in any given redemption period.
So they just say no.
Basically, if too many people ask for their money, the manager just says, nope, we are only allowing 10% of withdrawal requests to be fulfilled this quarter to prevent a fire sale of our assets.
So listener, here is your exam trap. The name hedge fund implies safety. In the old days, they used long-short strategies to hedge against market drops. But modern hedge funds, hedge does not mean safe. Mutual funds are public, liquid, regulated, and safe for retail investors. Hedge funds were private, highly liquid, aggressive, heavily leveraged, and strictly only for the wealthy who can afford to be locked in a burning building.
The exact causal chain the exam tests is this. Limited regulation allows for aggressive strategies. Those aggressive strategies create higher potential returns, but also significantly higher risk. Because the assets they buy are risky and often illiquid themselves, the fund must enforce lockups. Lockups prevent bank run panic selling, which means investors are fundamentally trapped during downturns.
Okay, wow. Take a deep breath, listener. We have covered a massive amount of highly complex ground. We've gone from DPPs passing through taxes, to REITs acting as landlords and getting crushed by interest rates, to hedge funds locking billionaires and burning buildings. It is time for the grand comparison and rapid-fire recap.
Let's do it.
I want to pull all of this together so it is crystallized in your mind before you walk into the test center. Let's build the matrix.
Let's compare the big three alternative products across the key vectors, the exam targets: structure, tax, and liquidity.
Vector 1, legal structure.
DPPs and hedge funds are generally structured legally as partnerships. General partners manage the business, limited partners invest the capital. REITs, on the other hand, are distinctly structured as trusts or corporations.
Vector 2, tax treatment.
DPPs and hedge funds use pass-through taxation. There is no entity-level tax. Investors receive a K-1 form. REITs, however, avoid the entity-level tax only by strictly adhering to the 90% distribution rule. Investors receive standard 1099 dividends taxed at ordinary income rates.
Vector 3, liquidity.
Listed REITs are the only highly liquid alternative investment we discussed today. They trade openly on exchanges. Everything else, DPPs, non-traded REITs, and hedge funds, are inherently dangerously illiquid, featuring lockups, lack of secondary markets, or extreme redemption restrictions.
All right, now for the rapid-fire recap. I'm going to throw out 6 punchy, fast-paced scenarios based on everything we learned. Expert, give me the one-sentence rule for each. Listener, this is your pop quiz. I want you to try to shout the answer out loud before the expert does. Takeaway number 1. Passive Pete's K-1 form shows a DPP loss from an oil rig. What can he offset with that loss?
DPP K-1 losses are classified as passive and can only offset other passive income, never active wages or portfolio income.
Takeaway number 2. Bossy Brenda is an LP in a real estate deal, but starts yelling at contractors and making day-to-day business decisions. What is her legal punishment?
By participating in management, she immediately loses her limited partner status and gets hit with unlimited personal liability.
Takeaway number 3. A REIT wants to avoid paying massive corporate taxes. What is the magic number they have to hit?
The REIT must distribute exactly 90% or more of its taxable income to shareholders every year.
Takeaway number 4. Since the REIT entirely avoided the corporate tax, what tax rate does the investor pay on those dividends when they get them?
They do not get the qualified rate. REIT dividends are taxed at the higher ordinary income rates.
Takeaway number 5. A broker tries to sell you a public non-traded REIT and says the word public means it's safe and easy to sell. True or false?
False. Non-traded REITs are public only because they register with the SEC, but they are highly illiquid, have stale NAVs, and charge brutal 10 to 15% upfront fees.
Takeaway number 6. High roller Harry wants into a new hedge fund. What fees is he paying and who is actually allowed in the door?
He is paying the 2 and 20 fee structure. His money is trapped by lockups, and the fund is strictly for accredited or qualified investors only.
Boom. That is the hit list. If you know the logic behind those 6 things cold, you are going to absolutely destroy this section of the SEC.
And as we wrap up, I want to leave you with a philosophical thought on everything we've discussed today, specifically on the overarching concept of liquidity.
Lay it on us.
We live in a world of absolute instant gratification. We treat liquidity, the ability to get our money back immediately whenever we want it, like a basic human convenience. We expect it from our checking accounts, our mutual funds, our stock trading apps.
Right, it's just expected.
But in the realm of high-level alternative finance, illiquidity is not a bug in the system. It is a feature you actively sell. When you hand over your capital and give up the legal right to touch your own money for 10 years in a DPP, or submit to a 2-year lockup in a hedge fund, you aren't just making an investment. You are actively being compensated for the psychological discomfort of being trapped.
Oh.
You are trading your peace of mind, your financial optionality, for a higher potential return or a unique tax shield. So the ultimate question these alternative investments force every investor to answer is simply this. Are you being paid enough for your anxiety?
Man, trading optionality for returns. Are you being paid enough for your anxiety? I love that. Listener, take a breath. You just absorbed a massive amount of complex, heavily tested financial machinery. Review your notes. Listen to this deep dive again on your next walk if you need to let the concepts marinate, and then go absolutely crush the SIE exam. You've got this. We'll catch you on the next deep dive.